Hello, welcome to Fundamentals in Accountancy, Business and Management 2. Now we will be discussing the statement of cash flow, but on another way to do it. That is the indirect approach of preparing a cash flow statement. Okay, so there is a slight difference from the direct approach, but don't worry, I'll be here to guide you all along. This is activity 8. Okay, okay, here is the problem. I think this is activity 8. Yeah, activity 7. So I hope you will follow me uh, per transaction so that we will be able to answer the preparation of cash flow using the indirect approach. Okay. So transaction number 1, invested 500,000 for his trading business and 20,000 for inventory. So he invested cash and inventory. So these are both assets. So they are both on the positive, on the not debit balance. Debit cash inventory of 520. So equity account, that's the contribution of the owner to the business, 520,000. Then we go to transaction number 2, bought equipment for cash, 150,000. We will compute for the depreciation with a salvage value of 10,000 at an estimated useful life of 5 years. Okay. So, but for now, we will just acknowledge the acquisition of the asset. So, when he acquired the asset, you will debit the equipment and credit the cash because he has to pay for the equipment. So that's a deduction to your cash. Borrowed 2 million at the bank, so that's the loan proceeds from the borrowing, so that is a debit to your cash. But because you borrowed money, you incurred a liability, so there is a credit of loans payable. Now we receive cash sales of 3 million and sales on account. So he had sales in two forms. One is the cash sale and the other one is the accounts receivable, okay, in the amount of 3 million and 1 million respectively. Now we have paid Meralco 5,000, so that is an expense account, so we have to debit it because expense has a debit normal balance. I know at this point you already memorized the basic rules on debit and credit and the most common transactions because we've been discussing it every now and then. So we drew 10,000 for his personal needs. So what is again the drawing account? Correct. It's a debit normal balance because it's a deduction to your equity account. So we debit drawing, and because there is a deduction to your cash, we credit cash. Number 7 transaction, purchased merchandise 70,000, paid half and the other half on account. So when you do a purchase in the periodic inventory, you debit the account purchases to acknowledge the cost of merchandise. So purchases is a cost account, okay? So purchases 70 debit, but you paid half, so you have to reduce your cash by 35,000 and you incurred liability for the other half. Next, number 8, paid half a bank loan. Okay, so you have to pay the bank loan, but in the earlier statement, it says that how much was the interest? 12% interest. Okay, so if you will compute for the interest, which I have done already earlier, I know you already are was this are familiar with the computation of interest. We've done it in the previous video lessons, but if you want to review, you can just go back to my other lessons. Okay, so loans payable, why did we debit it? Because that is a reduction to your loans. When you reduce your loans, you do a debit. So we debit loans payable by 1 million and you have to pay for the expense, interest expense, I mean. So you expense as a debit normal balance, so debit 100,000, but you pay for the loan principal and for the interest expense for that period. Next, we have the adjusting entry, okay, the accumulated depreciation. I think we have already discussed how to compute for the depreciation. But if you still need assistance, we can visit my previous vlogs, okay? Video lessons. So depreciation is 28,000. Accumulated depreciation is 28,000 also. And then the inventory for the goods is 20,000 at the end of the year. Then we have to prepare the ledger in the form of the account. So our cash has a balance of 4,200,000. Our loans payable, 2 million less 1. So our loans payable is only 1 million. And now we can see the trial balance. The trial balance, as you can see here, the debit column and the credit column. I know you have mastered that already. Then the total debit is 5,583,000 and the total credit is the same. The beauty of this is repetition of your activity will make you what's this so much familiar that in the end everything is just easy as breathing. Now we prepare the sales or the statement of comprehensive income. Siyempre, it starts with the sales, okay? You know already, I think you've already memorized the format. It begins with the beginning inventory of 20,000 plus the purchases less the ending inventory will give you the cost of goods sold minus it to the sales, you get the gross profit. Minus the expenses. So we have here the depreciation. Don't forget the depreciation, the utilities, and the interest expense. So we will be having a 3,797,000 net income. Again, we always prepare the income statement ahead of the balance sheet because we need the figure of the net income to your equity account later on. Okay, next we have Okay, now we have the balance sheet. So from the trial balance, all the accounts in the asset, liabilities, and owner's equity will be transferred in your balance sheet. So here it is. The total assets is now equal to your total liabilities and equity. Now we can now prepare for the indirect approach of statement of cash flow. Okay, let's discuss this one by one. As we have said earlier, I think the other week or yesterday, the indirect approach, the only difference of the indirect approach to direct approach is the indirect approach, there are differences in the way you do your operating activities. But in the financing and the investing activities, there are no changes. Okay? So we will concentrate on the operating activities. First, it must begin with the net income account. So how much is your net income? 3,797,000. Okay, let us look at your income statement if it is right. Your income statement, yes, 3,797,000. So we're correct. So you begin with your income statement, and from the income statement, we have to what? Okay, here now lies the problem. We have to reconcile the non-cash transactions. Okay, I'll give you a clue. Non-cash expenses, I think you can note this one. Non-cash expenses are added back to net income. So, non-cash expenses are added back to your net income, while non-cash revenues are deducted to your net income. Okay? Again, let me repeat it again. Non-cash expenses are added back to your net income, while non-cash revenues are deducted to your net income. Okay, because in our example here, first is the depreciation. Depreciation is added back. Why did we add back? Because this is a non-cash expense. Non-cash expense. You know that depreciation is an allocation only of the cost of the asset. Okay? So is there a cash involved? No, there is none. So the depreciation account should be added back to your net income. What did happen when you recorded the depreciation in your income statement? When you recorded the depreciation account in your income statement was reduced by 28,000. So if you are trying to reconcile it with your cash flow, it is understated because of the depreciation expense. Now, since non-depreciation is a non-cash expense, we have to add it back to your net income to reflect the real cash amounts. So again, we have to add back the non-cash expense of depreciation. Then we have here an increase in accounts payable. So when we say accounts payable, remember what was the transaction when we did the accounts payable? When you first first thing you have to consider is, why did I incur accounts payable? Of course, if you go back to your transactions in the past, you may think that, oh, you may be able to analyze that there was a purchases made. Okay, there was purchases made in the amount of 1,035,000. Okay, and how was the transaction? First, you debit your purchases and you credit your accounts payable. Your purchases is a cost account. So when you record the purchases in your income statement, what happened to your income statement? Yes, it was reduced. So since it was reduced, again we are the rule is non-cash, okay? Non-cash expenses are added back to your net income. So since this is a cost, a purchases is a cost account which reduced your net income, it must be added back. Okay, so we add back the purchases or the increase in accounts payable of 135,000. Then we have here the decrease in accounts receivable of 1 million. So why did we deduct the increase in accounts receivable? Again, receivable. That's a non-cash revenue. Okay? That's a non-cash revenue. What is the rule again? Non-cash revenues are correct, deducted. So non-cash revenues are deducted. So we have to deduct the increase in accounts receivable by 1 million. Why? Why do you think so? Okay, let's go back again to the transaction. How did you incur accounts receivable? Okay, when you incurred accounts receivable, maybe you had sales, because there are two forms in having a revenue: through sales on account or sales on cash. In this case, because this is an accounts receivable, so you incurred sales on account, so you debited accounts receivable, credit sales. Then when you credited sales, remember, you debited accounts receivable and you credited sales. Okay, when you credited sales, what happened to your net income? It increased, but that is not a cash transaction. So we have to deduct it from your cash flow. Again, the rule is non-cash revenues are deducted. Why? Because the tendency of having an increase in the accounts receivable is there is also a corresponding increase in your net income. But the accounts receivable is not cash. So you have to reduce it, I think you that's having an accounts receivable increased your net income, which in fact this is not a cash transaction. So when it increased your net income, your cash flow here is overstated by such amount. So you have to reduce the accounts increase in accounts receivable. Okay, let me repeat again. What are the two fast rules? Non-cash expenses are added or deducted? Correct. Added back. Okay. Non-cash revenues are deducted or added back? Correct. It is deducted. Okay. So that's it. That is why here in the operating activity, we have the increase in accounts payable was added back and the increase in accounts receivable was deducted. So now we have a net cash from operating activity of 3,860,000. So the same with the investing activity. Again, what is an investing activity? These are the activities which concern the purchase and sale of non-current assets to facilitate your business operation. So in this case, the company bought an equipment, okay, maybe to hasten the production. Okay, so the purchase of equipment, so that's a deduction. And then again, we have the financing activity. What is again a financing activity? Well, this concerns on the changes in the equity account and in the borrowings. Our purpose when we do a financing activity is, yes, correct, to increase your working capital so that you will have some money or some financing for your operations. Okay, so here, financing activity, we have the cash loan proceeds of 2 million and a deduction of withdrawal from the owner or the drawing account and the cash payment of the loan. Half of the loan was paid, so so deduction of 1 million. So net cash of financing 990. So the net cash from operating of 3,860 from the plus the net cash from the financing of negative 150 and the net cash from the financing of 990 will give us a net increase of cash of 4,700,000. Then you deduct your cash balance beginning, you get your cash balance at the end of 4,200,000. Who got this right? Okay, so where do you get your cash balance at the end? In your balance sheet. Okay, let us check if you have done it right. Okay, see, the cash balance at the end is 4,200,000, meaning you did your cash flow perfectly. Okay, so now, again, congratulations if you have perform this task, this exercise, because this is another form of performing or preparing your cash flow statement through the indirect approach. Okay, see you again next time and congratulations. I want you to look forward on our new topic next week, which is the statement of financial analysis. Okay, thank you so much. God bless everyone. Again, this is at your service, ABM with Teacher John.